In this week's video, we'll review the latest charts to help us answer the questions. Are stocks set up for a 2015-2016 like bearish reversal and lower lows? It's Friday, June 1st, 2018, and since the month of May is now in the history books, it might be helpful to look back to sentiment in the month of April 2018, April 14th, 2018. Stocks are on an epic roller coaster ride that's eerily similar to some of the most painful years in market history. April 23rd, Apple could head toward bear market as it faces more than just iPhone worries. April 30th, last call, the stock market rally winding down for these reasons. In summary, it was pretty easy to find bearish articles and bearish sentiment between roughly April 15th when this article appeared and April 30th when this article appeared. The last video that we published in the month of April was dated April 27th, 2018. And if you go back and watch that video, we said it was somewhat of a mixed bag, but we looked at some charts, including Amazon, and we said the monthly chart, this had somewhat of a bullish, engulfing look to it. And it told us, despite the negative sentiment, to keep an open mind about better than expected outcomes. If we fast forward to the present day, which was more helpful, the hard data and the facts, or the never-ending stream of gloom and doom headlines? After the monthly chart on April 27th told us to keep an open mind about better than expected outcomes, Amazon went on to post a monthly gain in the month of May of 4.05% and printed a new monthly closing high for 2018. How about the broader market? Were the gloom and doom headlines helpful that appeared between April 14th and April 30th? You can make your own call in terms of what's actually in the history books now for the month of May after these headlines appeared. The S&P 500 tacked on 2.16%. The Nasdaq returned in the month of May 5.32%, and the Dow gained just over 1%. When markets are trading near all-time highs, low-cost, passive buy-and-hold investing always sounds good. Sounded really, really good in here before the Nasdaq peaked in the year 2000. And it sounded like an absolutely fantastic idea in here in calendar year 2007, looking backwards, here looking backwards. Buy and hold works until it doesn't. And for buy and hold to work in the long run, you have to hold. That's why it's called buy and hold. I don't know many human beings that are going to be able to hold when the Nasdaq drops 75% from point A to point B, and most of us will believe that buy and hold doesn't work and our pie chart is broken when the market falls 55% from point A to point B as it did here. There's a monthly chart of the Nasdaq between 1998 and 2009. Therefore, from a probability perspective, it will be helpful to know, does the present-day Nasdaq look like this point here or this point here? So before we move to the S&P 500 in the 2015-2016 peak and lower low case, let's take a look at the Nasdaq because these charts are powerful. The Nasdaq monthly chart peaked at the end of February 2000. It was a leap year. 229 of 2000 was a peak. We went into a major bear market. Simple is better than complex. A downtrend is a series of lower highs and lower lows. Once this peak was reached on the monthly chart at the end of February 2000, it was never exceeded. We went into a major bear market and had a series of lower highs and lower lows. Similar situation. Now we're looking at a monthly chart of the Nasdaq between 2007 and 2009. The Nasdaq peaked on the monthly chart at the end of October 2007. And as we would expect when we go into a major bear market, we made a series of lower highs and lower lows. Once the bear market started on the monthly chart here, this peak was never exceeded on a closing basis. This is exactly what we would expect a downtrend to look like. Downtrends don't make higher highs, they make lower highs. Downtrends don't make higher highs, they make lower highs. Therefore, in the present day, if we believe that the Nasdaq peaked earlier this year, we would expect all of the monthly closes from here on out to be lower than the monthly close at the end of January, which was 74.11. Remember, downtrends make a series of lower highs. If we fast forward to the end of May, the Nasdaq just printed a new all-time monthly closing high at 7442, exceeding the high at 74.11 that was made at the end of January 2018. This really doesn't look anything like this, and this really doesn't look anything like this. Doesn't tell us what's going to happen in the future. It just helps us assess the probability of higher highs in the future relative to the probability of a series of lower lows. Downtrends don't make higher highs. Is it possible that the Nasdaq is peaking as we speak? Absolutely, positively, yes. But this hard evidence that we have in hand as of May 31st doesn't align with that yet, and we'll continue to take it day by day. One of the best ways to test a bullish hypothesis is to go out and test a bearish hypothesis. If a bearish hypothesis or setup carries weight in the present day, that puts a dent in the bullish case. S&P 500 daily, 2015, this is July, this is November here. If you know your market history, you might be thinking back, we had a plunge, a very sharp plunge in August of 2015, and then we had somewhat of a similar double bottom look here. We had a consolidation period, and then we broke out in a bullish manner, and rather than sustaining this bullish move from point B to point A here, the market went back into the box and actually exceeded these lows here. So this is a difficult situation here. We have a 12.46% drop from point A here in July of 2015 to point B, which occurred in August of 2015. We rallied, we have a breakout, and then a failed breakout. We go back into the box, and the drop from this point A here to this point B in February of 2016 was 14.26%. Regardless of whether or not this example lines up well with the present day, it does help us keep that open mind about all outcomes. In this case, we exceed these lows, and in the present day, that would be similar to 2532. If we saw a similar similar magnitude outside of the box, in the present day, we would move from 2532 all the way to 2489 on a closing basis, or 2458. This is an intraday low look here. The moral of the story, it helps us keep an open mind about dropping below 2532 in the present day, and also tells us to keep an open mind about the possibility of a failed breakdown as well. Price drops out of the box for a very short period of time and then basically closes on the box here, goes back into the box, drops out of the box, closes below it for 1, 2, 3, 4 days, and then we begin a sharp reversal in this direction here. One of the great things about reviewing this, as we've said in past videos, there's nothing magical about 2532 in the present day. It is simply a reference point. And if we exceeded 2532 in the present day, and we're somewhere between 1 and 3% below this level here, It's extremely important to remain incredibly flexible and push your ego aside. In the present day, it would be fair to ask, is it possible that we could move up out of the shorter-term orange box and then fail and have a fairly sharp drop and exceed 2532? Of course it's possible, but let's compare the two periods head-to-head. When we walk through this, you'll see these periods really don't match up very well, but it's still instructive to compare them. If we compare them from the highest closing high, the highest closing high in 2015 occurred in the month of May, and the highest closing high for the S&P 500 in 2018 occurred in the month of January. On May 31st, 2018, we were 125 calendar days from the peak. If we compare apples to apples, 125 calendar days from the peak in calendar year 2015 takes us to September 23rd, 2015. So in the present day, do we look just as vulnerable as we did here, or do we look stronger? If we use the same moving averages that we used in last week's video, which was the simple 110-day moving average in blue, all the way out to the 200-day moving average in black, we can see 125 days after the peak in calendar year 2015, we had shifted from what is a full-bore bullish look over here with blue the fastest moving average on top and price above all of the moving averages, and the slopes for the most part are all positive in here, to a more mixed look here. We have some bearish moving average crossovers. Blue is no longer on the top over here 125 days out, and we have one of those concerning tight cluster moves. We get a cluster of the moving average telling us to pay closer attention. We can get big moves out of tight clusters and moving averages. How do the exact same moving averages look today, 125 days after we peaked? And this analysis was done as of May 31st, 2018. The answer is quite a bit better. We still have, for the most part, a full-bore bullish look, with blue the fastest moving average on top. Price for the most part is above all of the moving averages, and the slopes are up. This looks a lot better than this here, where price is clearly below all of the moving averages. Our slopes are all down here, and we have several bearish moving average crossovers. But in terms of our recollection, we're probably thinking about this plunge here and this plunge here being similar. So if we shift gears to the plunge period and look 125 days out, the 2015 case, 125 calendar days after the plunge, and the way we did this here, in the present day, we peak, we come down, we go sideways, then we plunge. Here, we peak, we come down, we go sideways, then we plunge. So this was the date that we picked here to compare to this date here. 125 days out from this date here. At first blush, this doesn't look too bad, but that's not what we have here. Over here, we have the full-bore bullish look. Price is above all of the moving averages. Over here, price is below all of them. This really doesn't look anything like this, and more importantly, we have a full-bore bullish type look here. This is full-bore bearish. This is the concerning, you better pay attention, tight cluster look. And blue, the fastest moving averages migrated from the top of the cluster to the bottom here. We don't have anything like that 125 calendar days from this peak here. For the most part, we still have a full-bore bullish look. Moral of the story, we've compared it two different ways. From a trend perspective, the trends in the present day in 2018 are much less vulnerable to a lower low from a probability perspective than they were in 2015. That doesn't tell us anything about what's going to happen in 2018. It simply helps us assess the probability of good things happening relative to the probability of bad things happening. The probability of bad things happening at this point in 2015 was quite a bit higher than the probability of something similar happening in 2018. The probability of bad things happening, including a lower low below these lows, a lower low below these lows, is never zero. But if we line them up with a peak and then the plunge, a peak and then the plunge, the present day looks a lot better. Under our approach, while it sounds logical to try to read every bullish article and every bearish article, typically that will lead to watching the markets too closely. We'll have a tendency to focus on forecasts rather than the facts that are in front of us. And typically it's not very productive for us to worry about what everyone else is doing or what everyone else is saying. Under our approach, it's best just to stick to the facts that are in front of us. And as we noted in a short takes post back on March 6th, typically when you get a plunge out of a strong mathematical profile, the aftermath can be very, very volatile, frustrating, and confusing. And for our purposes and our time frame, typically when we get a plunge out of one of those strong mathematical profiles and the big picture still looks constructive, we're probably better off trying to hold our positions between point A and point B rather than trying to trade between point A and point J. It's not unusual to get whipsaws after a plunge. And when we try to avoid volatility, or if we're always fearful of the next pullback, we're always worried about the next bear market, if we're constantly going through if this could happen, if we have a short-term focus and short-term fear, unfortunately, typically that leads to over trading. And rather than protecting capital and adding value, especially after a plunge that occurs from a strong mathematical profile, we have a tendency to destroy capital and destroy value. As always, we'll continue to take it day by day. And if the data that we have in front of us allows us to remain patient, we will continue to do so. If the data morphs into something that says action needs to be taken from a defensive perspective, we will do so as well. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.